It's shiny. It's timeless. And it may be quietly wrecking your wealth strategy. Mindlessly shoving your money into gold is dangerous. Gold has a place, but you're probably using it the wrong way. I'm Grady Cool, CEO of Cool Wealth Management. Before you buy another ounce, I'm going to tell you everything you need to know about investing in gold. Theoretically, gold's supposed to hold value and keep pace with inflation in the long run. It has safely been considered valuable since the beginning of humankind. Weirdly enough, that's not how things have really worked out with gold. Take a look at this chart. This is the price chart of a fund, GLD, whose full intention is to track the price of gold. As you can see, gold has gone up over 700% in the past 20 years, whereas cumulative inflation in the United States over that period has only been 64.3%. That's a pretty big difference. Gold has done tremendously well over that period, and some people might even consider that commodities like gold earn 5% a year. But even at that rate, it would still only have earned 265% over that 20-year period. Really makes you wonder, why is gold a bad idea? Choo-choo! We never know when the fun train's gonna come to an end. When the only thing maintaining gold's value is the fact that humans like shiny rocks and we haven't found much more of it yet and don't look like we're going to anytime soon, it does raise some questions. I think most of us could agree that gold is likely to still be a good hold to value over the long term, but will it continue to go this well? Who in the world knows? It could go great. With all the economic uncertainty in the world right now, do not even get me started. Or it could plateau for several years since we've already seen a major run up in the past 2 to 3 years. This is why diversification is so important. If we have multiple sources of return, then if one of them does poorly or, just not as well as we expected, then something else should help offset that. Gold can fit well into an investment portfolio, just not as the default. Most US investment portfolios use domestic stocks as their primary driver of growth. For as long as the United States has been growing over the 100+ past years, stocks have grown right alongside with it. In theory, this makes sense. If a large portion of the economy is these massive companies that we're investing in, then yes, they should be growing alongside the economy. This is what I would refer to as the fundamentals of the asset. Basically, the reason that people feel comfortable investing in the asset. I like that one. It has good fundamentals. The fundamentals behind stocks to continue to grow at a fast rate are a little more sound than they are for gold, which is why people feel more comfortable with stocks as the default. Gold is typically used as an alternative option. There's actually an entire class of investments called alternatives, gold being among one of them, among other things like commodities such as silver and oil, and other special investments like hedge funds or cryptocurrencies. Alternatives fill a portion of a portfolio if you're uncomfortable with the standards of stocks and bonds, or if you have a large portfolio, it can help offset some of the poor return of bonds over the past 20 years or so. Personally, I don't count real estate as an alternative, even though a lot of places technically do. Outside of that, generally speaking, alternatives don't take up more than about 30% of most portfolios, including things like gold. Now, when should you consider gold for your investment portfolio? If you don't like bonds, you've had a bad time with them, then gold can help replace some of that within your own portfolio. For example, if you're 60 years old and 40% of your portfolio is in bonds, instead of having that be 40%, you could split that down the middle and have 20% bonds and 20% gold. Gold isn't just a bond replacement though. If you feel more comfortable having some of your wealth physically in your hands, that's all right. Let's say that, for example, you had a $3 million portfolio, but you wanted to keep a gold brick in your safe worth $250,000. Personally, I don't see anything wrong with that. That raises a good point. Not all investments need to be the absolutely highest return possible. Gold is done really well, but when it comes to building an investment portfolio, having things that fit your personal preferences and circumstances is ultimately what is key. Given that most investment portfolios need diversification anyway, gold can be a nice option to be able to make your investment portfolio more tailored to you. Hope you guys enjoyed, maybe learned a thing or two. If you have any questions, please let me know down in the comment section below. And other than that, I will see you in the next one. Bye!